welcome to the Property Wealth Podcast. We're so glad you're joining us today. If you've ever thought about diving into real estate but felt overwhelmed by the options, you're in the right place.
Absolutely, Sarah. Real estate can seem daunting, but there are some exciting avenues to explore, like real estate crowdfunding.
Right? It's such a fascinating concept that allows you to invest in property with others, reducing risk, and making it more accessible.
Exactly. And today we're going to unpack how crowdfunding works, the benefits, and some things to watch out for.
Plus, we'll share some real-life examples and tips on how to get started, even if you're new to the game.
Yeah, no need to have $1 million to begin. There are options for everyone, especially for those of us over 40 looking to build long-term wealth.
It's all about making informed decisions, right? And we're here to guide you through it.
So let's dive into the world of real estate crowdfunding and explore how it can fit into your investment strategy. So, when we talk about real estate crowdfunding, what really strikes me is how crucial it is for folks over 40, especially now. I mean, with retirement timelines getting closer, people are starting to think more seriously about how to build a nest egg that can withstand the ups and downs of the market.
Absolutely, Mike. And, it's not just about building wealth, it's also about protecting it. I read somewhere that inflation is a real concern these days. Like, the cost of living keeps rising, and that can eat away at savings if you're not careful.
Exactly. Many investors are looking for ways to hedge against inflation. Real estate has always been considered a pretty solid investment for that reason. If you put your money in a well-managed property, it can appreciate over time, often outpacing inflation. It's a tangible asset after all.
Right, and I think that's a big part of the appeal for people in their 40s and beyond. They want something they can feel secure in, not just numbers on a spreadsheet. I know a couple, let's call them Lisa and Dave, who were looking to diversify their investment portfolio. They were a bit nervous about the stock market's volatility, so they turned to crowdfunding as a way to invest in real estate without taking on the massive responsibilities of being landlords.
That's a great example. Lisa and Dave were able to invest in multiple properties through crowdfunding platforms, spreading their risk across different projects. This way, if one project didn't perform as expected, their entire financial future wasn't hanging in the balance.
Exactly. It's about that peace of mind, isn't it? And, a lot of people over 40 are also thinking about wealth transfer to their kids or grandkids. They want to leave something meaningful behind, something that can help them in the future.
For sure. I've spoken to investors who see crowdfunding as a way to create a legacy. One client, let's call him Tom, he started investing in real estate crowdfunding, not just for himself, but to eventually pass those investments down to his children. He's not just thinking about his retirement, but also how he can set them up for success.
That's a smart move. And it's interesting how emotional this can get, too. I think many people realize that financial security isn't just about numbers. It's also about feeling safe and stable.
Absolutely. The emotional side is huge. When people feel secure in their investments, it allows them to focus more on their lives and less on money worries. I recall another investor, let's say her name is Rachel. She was always stressed about her financial situation, especially with looming retirement. Once she got into crowdfunding, she found a sense of community and support. She wasn't just a lone investor anymore.
Community? That's a great point. Many crowdfunding platforms have forums or groups where investors can share experiences and advice. It's like being part of a team, which can be really reassuring.
Yes, and, with the current economic trends, post-pandemic recovery, shifts in the job market, having diverse investments can provide a buffer. Crowdfunding allows those over 40 to dip their toes into real estate without needing a huge amount of capital up front.
And that's a game changer. Instead of needing hundreds of thousands to invest in a single property, you can start with a much smaller amount. It opens the door for more people to participate in the real estate market.
Right, and it's also worth mentioning how the market has changed. Many traditional investment strategies may not yield the same returns as they did in the past. Crowdfunding offers new opportunities, like investing in commercial properties or developments that might have been out of reach before.
Exactly, and I think that's what excites a lot of new investors. seeing these opportunities that are accessible and can potentially provide solid returns.
And it's not just about the financial aspect, but also the potential for personal growth. Many people over 40 start to think about what they want their legacy to look like. Investing in real estate through crowdfunding can be part of that journey, creating not just wealth, but also a story to pass down.
Such an inspiring thought. It's like every investment isn't just a transaction. It's a step towards a future you envision for yourself and your family.
Exactly, Sarah, and let's not forget about the flexibility that crowdfunding offers. If you decide to invest in a specific project, you can choose how much or how little you want to put in based on your own financial situation.
Right. It's very empowering. You're not locked into one decision. You can adapt as your life circumstances change.
And for those approaching retirement, that flexibility is crucial. It allows them to pivot if needed, rather than feeling stuck in a particular investment strategy.
It's all about making informed choices, isn't it? Understanding the landscape and finding what works best for you at this stage in life.
Absolutely. And as we transition into discussing some core strategies, it's essential to remember that these options are tools to help you navigate toward your goals. Whether it's achieving financial security, leaving a legacy, or simply finding a way to invest that feels right for you. So getting into real estate crowdfunding, one of the first things to consider is the different types of crowdfunding platforms out there. Like equity crowdfunding and debt crowdfunding.
Right, and they each have their own pros and cons, right?
Exactly. With equity crowdfunding, you're essentially buying a piece of the property. You get a share of the profits, but you also share in the risks. If the property doesn't perform well, your investment can take a hit too.
But on the other hand, debt crowdfunding is more about lending money to a developer or property owner, right?
Yes, that's a bit more secure in some ways. You get paid back with interest, but you don't get any ownership in the property. So if you're looking for a steady income stream, debt crowdfunding might be appealing.
That makes sense. So how do you decide what platform to go with?
Good question. You want to start with some basic research. Look at the platform's track record, the types of projects they fund, and their fees. A lot of platforms will have like a minimum investment amount, so that's something to consider too.
Right, and I guess it's also about understanding the markets they operate in.
Absolutely. You want to look at the property types they focus on. For example, some platforms might specialize in commercial real estate, while others focus on residential.
So if someone's thinking about investing, they should have a checklist, right?
Definitely. A good checklist might include factors like location, property type, market trends, and of course, the financials of the deal.
Yeah, like the 1% rule, right?
Exactly. The 1% rule is a quick way to evaluate a rental investment. Basically, you want to aim for a monthly rental income that's at least 1% of the purchase price. So, if you buy a property for $200,000, you'd want to see monthly rents around $2,000.
That's a simple way to gauge whether a property is worth it, for sure. What about the 50% rule?
The 50% rule is another handy one. It suggests that about 50% of your rental income will go towards expenses. So if you're bringing in $2,000 a month, you should budget around $1,000 for things like maintenance, property management, and taxes.
That's super helpful. So if you're looking at a potential investment, you can quickly estimate your cash flow.
Exactly. And then you can look at the cap rate, which is the ratio of net operating income to the property's value. It helps you evaluate the property's potential return.
Right, so if you have a property worth $200,000 and it generates $20,000 in net operating income, the cap rate would be 10%.
You've got it. Anything over 8% is generally considered a good investment in many markets, but it can vary depending on the location and the type of property.
And these metrics can really help investors, especially those who are just starting out.
Yes, they give you a framework to assess deals, but you don't want to rely solely on these rules. It's essential to dive deeper into the specifics of each investment.
Like doing your due diligence, right?
Exactly. Check the local market conditions, the neighborhood's growth potential, and the property's history. All those factors play a huge role.
So would you say financing options are something to consider upfront as well?
Absolutely. Whether you're going for traditional financing, a hard money loan, or going through a crowdfunding platform, each has its pros and cons.
I guess traditional financing usually has lower interest rates but requires solid credit, right?
Right, and it might take longer to close a deal. Hard money loans, on the other hand, can be quicker to secure but come with higher interest rates. So it's really about assessing how quickly you want to act versus your budget.
And crowdfunding can be a way to diversify your investments without committing a ton of capital upfront.
Exactly. You can invest smaller amounts across multiple projects, which spreads out your risk. But you also want to be aware that you might be locking your money in for a while.
So it's really all about weighing your options, understanding your goals, and doing the research.
Definitely. And speaking of research, having a solid understanding of property types is crucial. Whether you're looking at single-family homes, multifamily units, or commercial properties, each requires a different approach.
Yeah, and the rental market can vary so much depending on the type of property, too.
Exactly. For example, multifamily units can provide more cash flow than single-family homes, but they also come with higher management demands.
And commercial properties can have longer leases, which might mean more stability, right?
Yes, but they can also be riskier. If a business fails, you might find yourself with a vacant property for a longer time.
So it's about finding that balance between risk and reward.
Right, and always remember to keep an eye on the local market trends. You want to invest in areas that are growing or have potential for growth.
And that's where understanding demographics can come in handy.
Exactly. Knowing the population growth, job opportunities, and even school districts can help you predict how a property will perform over time.
So it sounds like you need to be thorough in your evaluations.
Absolutely. And that leads us to common pitfalls. Many new investors underestimate the importance of due diligence or overestimate their returns.
That's a classic mistake, isn't it?
It really is. And sometimes people get too emotionally attached to a property and ignore the numbers.
So keeping that analytical mindset is essential.
Yes, and always be prepared for unexpected costs. Real estate can be full of surprises, and having a financial cushion can save you from a lot of headaches down the line.
So to wrap it all up, it's really about being informed and prepared.
Exactly, and with the right strategies and a solid understanding, you can navigate the world of real estate crowdfunding successfully.
It sounds like a journey worth taking.
You know, Sarah, one of the biggest pitfalls I see, especially with new investors in real estate crowdfunding, is over-leveraging.
Oh, definitely. It's so tempting to use that leverage to maximize returns, but it can backfire, right?
Exactly. I once worked with an investor who bought into multiple crowdfunding projects, thinking that higher leverage would lead to higher gains. But then the market shifted, and suddenly those projects weren't yielding the returns he anticipated.
That sounds rough. What happened next?
Well, he found himself in a tough spot, with monthly payments that he couldn't keep up with. He had to sell off some assets at a loss just to cover his debts. It was a hard lesson learned.
Ouch, that's a really harsh reality. So how can someone avoid that kind of situation?
The key is to have a solid understanding of your financial limits and to keep a close eye on your debt-to-income ratio. Make sure you're not stretching yourself too thin.
That makes sense. I mean, it's great to be ambitious, but there's a fine line, right?
Right, and then there are the bad tenants, which can really drain your resources.
Oh, for sure. I've heard so many stories about that.
I had a client who invested in a crowdfunding project that involved rental properties. They were so focused on the potential returns that they didn't thoroughly vet the tenants.
That's so important. What happened?
Well, they ended up with tenants who, let's just say, they didn't respect the property. There were constant complaints from neighbors, and eventually they had to evict them. The cost of eviction, repairs, and lost rent really added up.
Yikes. That's a nightmare. It sounds like doing proper due diligence is key here.
Absolutely. It's vital to check references, conduct background checks, and even talk to previous landlords if possible.
And what about cash flow? I feel like that's a huge aspect that sometimes gets overlooked.
You're right. Some investors get so caught up in the excitement of a project that they forget to analyze the cash flow. I remember a case where an investor was dazzled by high projected returns, but when the project went live, the actual cash flow didn't cover the operating expenses.
That's frustrating. How do you ensure that cash flow is sustainable?
Always look at the numbers critically. Factor in all expenses, including maintenance, management fees, and even unexpected costs. If the cash flow doesn't comfortably exceed the expenses, that's a red flag.
And timing the market? That's another common mistake, isn't it?
Definitely. Timing the market can be a gamble. I had a client who waited for the perfect moment to invest, thinking prices would drop. But instead, they missed out on great opportunities. And by the time they acted, prices had already surged.
It's like trying to catch a moving train.
Exactly. A better approach is to focus on long-term growth rather than trying to predict short-term fluctuations.
That's a great point. And hidden costs? Those can really sneak up on you, can't they?
Oh, yes. I once had an investor who was caught off guard by unexpected fees. They assumed that the crowdfunding platform was all-inclusive, but they didn't account for maintenance costs, insurance, and other hidden fees.
That must have been a shock.
It was. They ended up losing a significant amount of their projected returns because they didn't prepare for those extra expenses.
So what can listeners do to spot these red flags early?
Well, first and foremost, always do your homework. Research the crowdfunding platform thoroughly, understand their fee structure, and read reviews about previous projects.
That's really important. And talking to others who have invested in similar projects can provide valuable insights too.
Yes, networking with other investors can help you identify potential pitfalls and learn from their experiences.
And what about keeping a close watch on market trends?
Absolutely. Staying informed about market conditions can help you avoid making decisions based on fear or hype.
So it sounds like there's a lot to consider before diving into a crowdfunding investment.
For sure, but it's also about being proactive. If you do your due diligence and stay informed, you can mitigate a lot of these risks.
And if someone finds themselves in a tough spot, what are some steps they can take to recover?
Well, first it's important to reassess your investments. Look at what's working and what's not, and don't be afraid to make changes.
That sounds like a smart move.
And if cash flow is an issue, consider renegotiating terms with lenders or looking into refinancing options.
That's a proactive way to handle it.
Also, don't hesitate to seek advice from a financial advisor or a mentor. They can provide perspective and help you navigate tricky situations.
Great advice, Mike. It's all about being informed and taking thoughtful steps, isn't it?
Exactly. Real estate investing can be incredibly rewarding, but it requires careful planning and ongoing education to truly succeed.
Well, I feel like we've covered some really valuable lessons here.
I agree. It's all about learning from others, experiences, staying educated, and being mindful of potential pitfalls.
And with that, we can transition into discussing next steps for those who are ready to take the plunge into real estate crowdfunding.
So, if someone's feeling inspired to dive into real estate crowdfunding, where do they even start?
Right, it can feel a bit overwhelming at first, but it's really about breaking it down into manageable steps, isn't it?
Exactly. First off, I'd recommend setting aside some time to do your research. You could start with a couple of the well-known crowdfunding platforms.
Yeah, platforms like Fundrise or Realty Mogul are great places to begin. They often have educational resources right on their websites.
And don't forget to check out their minimum investment requirements. Some platforms allow you to start with as little as $500 or $1,000, which is quite accessible.
That's a good point. And while you're exploring those platforms, it might be useful to create a checklist.
Absolutely. You could include things like what kind of properties are they focusing on? What's their track record? What are the fees involved?
Oh, and also look into their customer service. If you have questions, you want to make sure you can get support when you need it.
Right, and once you feel comfortable with a platform, start small. Maybe invest a little and see how it goes.
Yeah, and while you're at it, consider using some investment calculators to run the numbers. Tools like the Bigger Pockets calculator or Deal Check can help you analyze potential returns.
Those calculators are super handy. They can help you understand cash flow, ROI, and other important metrics.
And don't overlook apps like Rentometer to gauge rental prices in the area. It's a quick way to see if a property is priced right.
Plus, if you have access to your local MLS, that can provide you with valuable insights into the real estate market.
Definitely. And, another step is to start building those good habits. Maybe set a goal to analyze one deal a week, just to get into the rhythm of it.
That's a great idea. And joining a local real estate meetup, either in person or online, can really help too. You'll find a community of like-minded investors.
Right, and those meetups are a goldmine for networking and sharing experiences. You can learn so much from others who have been through similar journeys.
And while we're on the topic of learning, there are some fantastic books out there. Have you read the book on rental property investing by Brandon Turner?
I have. It's a must-read for anyone thinking about real estate. I'd also recommend The ABCs of Real Estate Investing by Ken McElroy.
Those are solid choices. Also, podcasts can be a great way to absorb information during your commute or while doing chores.
Absolutely. Bigger Pockets podcast is a great one, and there are tons of episodes focused on different investing strategies.
And Real Estate Investing for Dummies is another resource that breaks things down nicely.
So many options to choose from, and the key is to just start where you are. You don't need to know everything at once.
Exactly. Just take one step at a time. Maybe set a goal to read a chapter of a book each week or listen to a podcast episode.
And don't forget to reflect on what you're learning. Keeping a journal or notes on what resonates with you can really help solidify your understanding.
That's a great tip. And remember, it's all about building that foundation. You don't have to rush into anything.
Right? It's about creating a sustainable plan that works for you and your lifestyle.
So with these tools in your pocket and a clear roadmap, you're ready to move forward. All right, so let's wrap up our discussion on real estate crowdfunding options. I think one of the key takeaways is definitely the accessibility factor. Crowdfunding opens the door for many investors who might not have had the means to invest in real estate before.
Absolutely, Mike. And then there's the diversification aspect. It allows you to spread your investments across multiple projects, which can really help mitigate risk, right?
Yeah, and let's not forget about the potential for passive income. Many crowdfunding platforms offer opportunities for regular cash flow. It's a great way to earn while you focus on other things in life.
And, of course, the importance of doing your due diligence. Researching the platforms, understanding the projects, and checking the track records of the sponsors is crucial before you invest.
Exactly. It's all about being informed and making smart choices. And remember, real estate can be a powerful way to build long-term wealth, especially as we're looking at options that fit our lifestyles and goals after 40.
Right. So for everyone tuning in, we encourage you to like this episode, subscribe to our channel, and drop a comment with your biggest takeaway or any questions you might have about real estate crowdfunding. And don't forget to share this with someone over 40 who's thinking about investing in property. They might find it really helpful.
And speaking of helpful, next time, we'll dive into a really interesting topic, REITs versus direct ownership. I think it's going to spark some great conversation, especially for those trying to figure out what suits them best.
Yeah, I can't wait for that. It's such an important decision to make. So until next time, keep exploring your options. And remember that building wealth through real estate is a journey, and you're not alone in it.
Take care, everyone.
Bye for now.